Hey there, everyone. Dave Keller here with Market Misbehavior, and welcome to another edition of the Market Misbehavior podcast. Our goal with this podcast is to sit down with top practitioners, investors, money managers, educators, authors, and of course, technical analysts to pick their brains a bit, learn about how they follow the markets, how they are, what their thinking is, and how that's evolving through the course of uncertain times and challenging periods, and to really think about what makes them tick and how they their approaches and their lessons learned can help inform our own decision-making going forward. Great guest today, Chris Vermeulen of thetechnicaltraders.com. I've known Chris for a number of years. He's a Toronto-based technical analyst and really an excellent market practitioner. He is a fantastic trend follower, and I think you will find our conversation today ends up being sort of a mini masterclass on trend following and the benefits of focusing on the message of the market. Certainly a message that resonates very much for me, and I hope for you as well. You know, we talk about the market conditions. We recorded this just the day after the Fed meeting in December as the markets sold off aggressively in the last hour and a half of trading. Today is the day after, and it was fun to sit down with Chris on how to make sense of a day like that, how to recognize the difference between the short-term fluctuations and some of the noise with some of the longer-term trends and what to look for in terms of following asset flows and recognizing when the conditions have changed enough that it deserves to, you deserve a change in your portfolio. We talked about the dangers of high dividend paying stocks, and he had some myth-busting charts showing some of the underperformance of high dividend payers during periods of market instability, which I thought was really interesting to review right about now. We did some interesting comparisons of investing to surfing. We talked about tides. We talked about waiting for the right wave and all sorts of things that I just loved. I was jotting down notes as Chris shared some really cool insights about how to think about the markets related to some other disciplines. We talked about particularly energy and crude oil and the weakness in energy. He actually sees a potential further downside in energy stocks, although they're a bit oversold now. I thought his comments about the dangers, potential pitfalls for crude oil and what that could do to energy stocks into next year, an area where I'm sure some people are looking because they've been underperforming for a while, I thought was really interesting. And he had a great idea, which I have not heard a lot, about how to be positioned going into the beginning of new year. If you are concerned about market downside, I thought his idea toward the end of our discussion was a pretty interesting one that I'll certainly be following very closely. So please enjoy my recent conversation with Chris Vermeulen of the Technical Traders. All right, everyone, welcome to the Market Misbehavior podcast, and I'm super excited to sit down again with Chris Vermeulen of the Technical Traders. Chris, we haven't caught up in a while, but it's good to see you again. How have you been?
Thanks for having me, David. Yeah, pleasure. Everything's great. Holiday season's here, ready for some heat. Go down south, and markets have had a great year, so it's tough to complain.
And we're in Seattle, but I think you're even further north than we are. You're in the Toronto area, right?
Yeah, up near the North Pole. I know.
Yes.
But we are covered in snow.
Okay, a little Florida will do us both well, I feel like, over the holidays. But no, it's really good to see you, Chris, and especially, I mean, thank you for boldly coming on the podcast during, I mean, one of the more painful weeks I feel like investors have experienced, with the post-Fed sort of initial sell-off there. If we could just start off, I mean, give us a sense of where is your head at? And I know a lot of investors are kind of just struggling with how to make sense of what we've now experienced after an incredibly strong 2024. Where is your head at right now in terms of the current market conditions?
Yeah, so from a high level, I mean, there's so many data points to pull from, but from a really high level, I think we're inching closer and closer to a major market top. I feel like the economy is slowly coming to a grinding halt. Momentum's for all kinds of different assets and real estate and unemployment and sales. I think they're all slowly kind of grinding to a halt. We're seeing various assets like precious metals, more so gold, outperform. Energy stocks outperform. We tend to see these do very well when there's chaos, uncertainty. People are expecting World War III and high oil, which is probably why energy stocks are like at nosebleed territories, even though oil's been crashing and underperforming. I really feel like, I think January is going to be a big turning year for the equities market. There's kind of this thing where if January closes positive on the month, it could be a really strong year. If it closes negative, so I feel like Trump getting in, and there's all kinds of things in play that January could be very volatile. I'd like to see how it closes out. I have a fairly bearish bias for the equities market, the economy for 2025, but we have to let this beast continue to unfold. We're still in a bull market. We're still running higher. This recent little bloodbath after the Fed really it's just a news driven move. I mean, it's such a huge drop. We saw the VIX spike like 74% after the Fed came out. And I think a lot of people are just trigger happy. The market climbs a wall of worry. They've been looking for something to worry about, and that kind of rates aren't really going to fall, and inflation's here to stay for a while. So that's really spooked people more so than the rate cut didn't, I think, have that much play into it. I think it's the long-term forecast that's got people spooked, inflation and rates not really falling. But I actually see things being very different long-term. My view, and I meet with a lot of different entrepreneurs in different industries, and I believe we're going to eventually see inflation come down. I think we're going to have a huge market reset, and I think it'll be a little bit of a depression, and it'll reset the markets. People will stop buying. There's going to be bankruptcies and layoffs, and eventually nobody buys stuff and prices come down, and there'll be a huge financial reset. Like, that's the worst case scenario, but I believe it could happen. So the Fed's just like, oh, we just think, just keep rates relatively high will help fight inflation. But I do think there's going to be a big reset, especially in real estate. And that is going to catch a lot of people off guard, which triggers fear in other assets if they have to take a loss on their home. Or I know people who are overextended in real estate, and now they're underwater already. And the housing market, to me, hasn't even burst yet. Like, it's really just settled down a little bit. So there's a lot going on, but I think you got to be long this market. And the market had a little buck with the Fed. The market's great at trying to buck people off a bull market. And, the sharpest pullbacks, as you know, typically happen during a bull market, and the sharpest rallies happen in a bear market. So this isn't out of the norm, although people seem to panic when it does happen.
So you mentioned a number of different things, and I think you've highlighted some of the themes that absolutely could play out going into the beginning of next year. Obviously, in the U.S., we have a new president coming in, potentially dramatically different policy shifts that could be, certainly a lot to digest for the markets. But then we've had a brief pullback, even though the trends are still strong. So how do you I guess navigate between now and when some of those negative scenarios play out? Like, what would be the warning sign that would tell you, okay, this is getting serious today, as opposed to this is something that could happen down the road? Like, are there charts you would be watching that would help you navigate, okay, now's the time when we really need to start, getting defensive or finding greener pastures?
Yeah, so there's a few things I like to look at. A lot of it has to do with money flows in various asset classes.
Yeah.
How are different assets performing? Are utilities starting to outperform stocks? How is gold outperforming the markets and bonds? All these things. And money flows, how much money is actually flowing, and fear. Really, I still follow price. Price is, the only way us as investors make money is price needs to move in our favor. So that is like the final straw. So this has been a sharp pullback. We closed out actually our QQQ position a couple of days ago, just before we saw it spike up and then reverse back down, or just before it reversed back down. But we still hold the SP 500 because the long-term trend is still up. And I follow the daily chart, and I follow cycles, and I use momentum, and I like to see where money's flowing. So, we don't just hold long-term. We do move in and out with market corrections and things like that. So we're long right now, but if the market pulls back for another day or two, potentially it could trigger us saying, hey, listen, money's kind of retreating. There's been a little shock wave through the system, and we're best to step aside and wait. So it's based on a daily strategy. We're kind of using daily cycles. The cycles usually last, 40, 50 days or so, depending in there. And we want to see how things unfold from that perspective. But yeah, it's really about following price. And as you know, you can't really pick a top. If you do, it's a good guess. So we have to let price break down and lose its momentum. And then our technicals will say, okay, not only has price stalled and started to change direction, which means we need to get out, but we also have position management in place that if it falls too far or a supportive stop is broken, we're just going to get out anyway. So it usually comes down to position management and also trend reversal.
Chris, you and I are kindred spirits, and I knew that going into this conversation, and I love that answer. Really focusing on price, right? And I feel like I often tell people the charts will tell you when you need to be in some other place. So let's let the charts do the do the messaging. You sent some charts, brought them along with you, and I want to go through some of them. The first one is really looking at what we've experienced right now versus some potential safe havens I know people would have in mind. Can you talk us through this one and what it's telling you?
Yeah, so I think one of the big things I'm really trying to focus on is how to protect people's life savings, their retirement. And I think one of the biggest misconceptions is people with kind of the buy and hold strategy or the mentality that I just bought more dividend stocks, I'm in dividend funds. Everybody I talk to say they're holding dividend stocks. And this is a split screen here. The top chart is the SP 500. The bottom chart is the SP 500 high dividend ETF. And so most people move into dividend stocks. The retirees say, just give me a good yield. These big companies are rock solid. That's why they pay dividends. But what people don't realize is the majority of the money in the stock market is from investors 50 plus. And they all have the same strategy. They all hold the same stocks. And so when they start to panic, they all sell the same stocks. So if you look at the dividend stocks, as investors get worried, they start dumping SPYD, the bottom chart. And the dividend stocks are down almost 9%, almost 9 times that of the SP 500. And so investors think dividends are a low volatility, safe play. They're actually way more dangerous than most anticipate. And the stock market has only pulled back 1%, yet people are taking a pretty big haircut on their dividend stocks, and they're taking all this risk to squeeze out that extra 3 or 4 or 5% yield, which actually isn't that much because the SPY itself pays a nice yield. So you're only really getting a tiny little extra yield for moving in and holding actually more volatile assets. And it's these beliefs that I'm trying to break that people need to understand, because I believe if we go into a big recession in a stock market financial reset, you do not want to be holding dividend stocks, the stocks that all the big money is holding, because when they all start dumping, it's just going to turn into a waterfall sell-off like we're seeing in dividend stocks right now.
One of my former Fidelity analysts used to say, charts are the truth serum for the market. So great way to bust myths about what should work or what could work. Is actually shows you what's happening and what actually is working. I love that chart, really showing the differentiation between the two. You also brought a chart looking at sort of that COVID peak and then the COVID crash. How does this relate to what we just looked at?
Yeah, and so this is the same thing. This is just what happens during a crash when people panic. COVID was unexpected. It was new for almost everyone here involved in the markets. And the top chart of the SP 500, it crashed 36%, which is pretty jaw-dropping and pretty painful. But you look at investors in the bottom one, in dividend stocks, they lost almost half of their portfolio value in the same amount of time. And here people think they're in these safe, defensive, protective, like slow moving beasts, but they're actually in more volatile assets than the index itself. And the bad thing with this is that bonds crashed as well. So not only did you take, if you're diversified and you have the buy and hold portfolio, you took a hit on both sides of your portfolio. And that's like really does so much damage. People look at stocks and bonds, as you know, kind of like one kind of hedges the other, but if you follow price action, if both are trending down, you really don't want either of them. And but the old strategy isn't like that. It's like split 60-40 or whatever your split is. But when the markets, as you know, are a living, breathing thing, you have to change with the trends. And so that's what I focus on, is which assets do have money flowing into them, which assets are people moving away from. We want to make sure we hold the asset that is rising, that money is going to, and just ditch the other one. We can always buy back bonds later, or precious metals, or whatever your favorite asset is, but just own it when it's going up and wait for it to confirm that, right?
It's such a great point, Chris, and I feel like a lot of and really the financial industry probably guilty of this, just pounding in people's heads diversification and the benefits of diversifying. I always tell people that means you're literally diversifying into at least one thing that's probably not working very well at this moment. So why don't we diversify into strong charts, right? And maybe that's the opportunity.
I think a big thing too, like I always like to, like the analogy, like I'm a surfer, I live on the water, and I like to look at the stock market like the ocean tide. If we're in a bullish phase, the tide is going up. And as we know, a tide lifts all boats. When the tide goes down, all boats go down. The stock market is the same. I talk to people all the time. They're like, oh, I'm diversified. I got this sector and that sector and this commodity and this. And I'm just like, they're all stocks within the stock market. And when we go into a bear market and the tide goes down, they're all going down. Just some go down faster than others, right? And I'm like, the stocks in general is one asset class. Not 10 sectors doesn't mean you're diversified. It means you have a bunch of the same thing, really. And people are like, what do you mean? I'm like, yeah, they're all going together. And that's why I like to move from one asset class to another, because
the correlations between sectors are way stronger than I think probably a lot of people want to admit for sure. Another chart you brought with you that I think is a really interesting one is looking at the energy sector in particular. Energy stocks have not been particularly strong. They're rotating lower along with pretty much everything else. Do you think this is an area that starts to emerge in a position of strength or more caution going into the new year?
I think they're oversold energy stocks. I think they're
Yeah.
ready for maybe a little bit of an oversold bounce, and maybe we get that holiday kind of squeeze and rally once this Fed little shakeup kind of dissipates a bit. But I'm very bearish on the energy sector. Actually, this chart doesn't go back far enough, but you go back to like 2008 market top. Energy stocks were right up at this level. Every time we get
Yeah.
to this level, energy stocks take a really big beating. We go into some weak economic environment. And as we can see in this chart, the top is the XLE energy sector space, and the bottom chart is crude oil, and they're diverging. And
Yeah.
oil has been moving down while energy stocks have been moving up, which is not a good sign, really. I think we're just waiting for oil to break down, and energy stocks are going to spill over, break down through that kind of support trend line and start to sell off in a big way. And all those little purple lines across the top chart there, those are all dividend payments. And that big sell-off we saw in this dividend ETF has a good chunk to do with XLE. There's a lot of big dividend-paying stocks in the dividend space. And so we're seeing a pullback. A lot of people are worried. They're like, why is the energy space down 14%? I'm like, you shouldn't be worried about that because it's still actually in a longer-term uptrend. It's like when it breaks that, it's the next like 40, 50% haircut that is going to hurt. So I think we're just waiting for poor economic data. Oil, I think, is going to break down, hit that 45 mark next year, and energy space is going to catch up in terms of stocks falling and breaking down. So I do feel like the markets are still in an uptrend in general. The stock market, I think energy space will have a bounce. I don't really think they're going to go to new all-time highs. To me, the big play will be when oil breaks down. I think the energy space will be a spot you don't want to hold or take advantage of falling energy stocks because I think it'll be pretty precipitous once it starts.
That's one of the, I don't know if it's a surprise for the year for you, but if you had told me before 2024 there will be a huge conflict and a rapidly growing conflict in oil producing regions, multiple conflicts, I would assume oil prices would be pretty strong. I would assume energy stocks are probably doing quite well as a result. But then what a consistent review of the charts has reminded me is the market doesn't care what I think should probably happen to oil prices. They've just remained pretty underwhelming. It's probably one of the most underwhelming charts of 2024, I would probably guess, right?
Yeah, oil. I usually cover it every day for followers, and
Yeah.
I'm always like, nothing much has changed. Oil is such a boring chart to talk about the last the last year, really. And but as you just said, David, everyone's expecting like chaos and high
Yeah.
oil pricing, which is why all the investors have been moving into energy stocks and why they're trading at what I think are nosebleed pricing. And all we need is one bad piece of economic data, and oil is going to slip through the floor and away it goes. And I think then people will start retreating from the energy space in a much bigger way. So, yeah.
No, good charts. The last one you brought with you that I want to make sure we cover really looks at stocks versus bonds, I think, in an interesting way. Talk us through this one, what it tells you about the conditions here.
Yeah, so this is my strategy. This is kind of what I've been touching on, how I focus on moving into an asset class that is performing and getting out of the ones that aren't. So the top chart is the daily chart of the SP5, or sorry, of the QQQ. The bottom chart is TLT bonds. And so a few months ago, we had a sell signal in bonds. We were long the bond market, TLT. We exited that because our strategy was saying, hey, money flow is moving into equities. It's going into higher risk plays. We're starting to see the stock market outperform everything else from bonds, utilities, gold, and things like that temporarily. And it generated a signal saying, get into equities. This is where the money seems to be going. And so we sold that position, and we've been riding it up higher ever since. We actually locked in 10% on our QQQ trade. We still hold the SPY. It's a very similar chart to this because the trend remains up. But this is like a perfect example of why you need to make sure you don't diversify and just hold a bunch of stuff. Because if you hold, 60-40 split, 60% stocks, which is the top chart, and 40% bonds, which is the bottom chart, one's up 10%, one's down 10%. You don't really make a whole lot of money. You're just wasting time and effort and all that. So that's what I focus on, is find out where the money's going, confirm there's a trend, a strong enough wave, and hop on that wave. And kind of just like how the tide goes in and up and down, I picture like a surfer. So when you see a surfer floating out past the breaks off the beach of Florida or somewhere, what are they waiting for? They're waiting for that set of waves to roll through, right? And every year there's 5 to 12 sets of waves. And so that's what this is in the stock market. We had a new set of waves rolling in, and we pick the one that meets our risk and our portfolio criteria. And then we hop on that wave and we ride it. And the nice thing about riding a big, strong wave is you also know when it's starting to weaken, when to block in profits, tighten up stops. We see waves coming and trades coming 3 or 4 days in advance. We know when they're going to end 3 or 4 days in advance. We don't have that shock and awe. It's not like we're reacting. We're actually like prepared, strategies in place, and we just follow the plan. And that's super important, is to make sure you just say, hey, let's get out of this asset. Let's move to the next one. It's, a beautiful swell coming across. Let's hop on this and go.
I love the proliferation of surfing analogies here in December. This is beautifully done, Chris. Thanks for that. Thanks for that little holiday gift for all of us.
Right.
So if what you're saying is true, obviously stocks, generally speaking, have come off, but a lot of the major indexes are still in decent shape. But we've seen a lot of weakness in other areas of the market, in commodities, in bonds, and elsewhere. If all of what you're saying is playing out, and it could be a challenging beginning to the year, where do we go? Where do you see opportunities? Is it sticking with things like the NASDAQ that, as long as they remain strong, or are there other opportunities, other areas? Like, where should we be thinking about positioning?
Yeah, so I still think the position, I like the SP 500 the most. While it may not outperform dramatically, to me, it's a bit more of a broad market gauge. Trends tend to last longer. So I still like equities, but to me, one of the best plays I think going forward for the next 6, 8, 12 months is actually going to be a currency play. I'm in Canada. I want to hold US dollar. The US dollar is primed and ready to continue to move higher, and just holding just US dollars itself has been a huge gain over the last several years. And I think the US dollar is going to continue to expand higher, especially from a Canadian currency standpoint. Based on technical analysis, looking at the conversion chart here, I come to the conclusion that we could see a $1.73 exchange, meaning one US dollar is $1.73 Canadian. So we're going to be talking potentially new highs I've never seen. And it is a huge opportunity. We're looking at 20% upside just for holding a currency. And I love currencies because they move slow. They trend really nicely. Just like back in 2022, we went into a mini bear market. One of the plays we did was the US dollar index. It rallied 18%. And the biggest pullback through the entire year was less than 4%. Like, talk about a low volatility, consistent trend, an easy way to pull money out without sweating bullets and panicking.
And that's 2022, by the way, when pretty much everything was going down. The US dollar is one of the few charts that was actually kind of working, right?
Right, which is why I like this play. Is I don't even have to buy anything. I can just hold US dollars in my brokerage account. Or people can take advantage of the US dollar index. There's ETFs for that. So if you're already in the US and you hold US dollars, you can take advantage by moving into the dollar index ETF to actually add more juice to your Canadian or your US dollars.
Yeah, I feel like we were talking before we started. I feel like the opportunities, the levers that individual investors can, and even advisors can pull in terms of ETFs, leveraged ETFs, just different exposure now more than ever, you have those different opportunities. So even playing a bullish dollar bet, there are ways to do so if you dig into it. This has been like a mini masterclass in trend following and in focusing on the message of the markets, Chris, which I really appreciate. I think there's a message a lot of people need to hear right about now as we're trying to make sense of what's going on. Can you tell us just briefly, what are you doing at the Technical Traders, and where can people find more information about you and your work?
Sure. Yeah. Well, at the Technical Traders, every morning before the opening bell, I share a video. I share my screen. I run through all the different asset classes and sectors and commodities, all of that stuff. We talk about what the market did yesterday, what's happening in pre-market, what to expect with our positions. And all I do is I manage my own capital, and I share my ETF trades with subscribers. I use this asset revesting strategy where we move from one asset to the next, whether it's equities, bonds, it could be a currency, it could be just a cash position like BIL, collect daily interest in monthly dividends when nothing is favorable. So I just share my trades, and I educate through the morning updates, keep everybody on the pulse of the markets. And when there's big panic days, I try to hold their hand and say, listen, this is normal. This nothing out of the norm. You don't have to, the sky's not falling. The amount of fear that hit yesterday the NASDAQ was like at all-time highs the day before. And then one little piece of news and everybody thinks the world is coming to an end. I'm like, guys, we were at all-time highs a day ago. Chill.
When in doubt, zoom out, right? Let's keep a proper perspective on days like this. And I see your book in the background, Asset Revesting. When did that come out?
I published that last year. Yeah.
Yeah. That's awesome. No, congrats on the book. I think it was well done. I have it on my bookshelf, and I'd encourage people to check it out for sure. But really hits on some of the things we talked about today with, trend following and focusing on the things that are actually moving in the way that's going to help your portfolio. Chris, awesome to see you. Thanks so much for coming on today. Wish you a very happy holiday season. Safe travels to Florida. Enjoy the warmth, and I hope we can catch up again in the new year.
Sounds great, David. Take care and happy holidays.
So there you go. A fun conversation with Chris Vermeulen of thetechnicaltraders.com. And I'm not kidding. I did buy his book, Asset Revesting. It's really well done. I'd encourage you to check it out. Really good deeper dive into some of the concepts and themes that we talked about into today's discussion. I really appreciated his analogies relating investing to surfing. I've compared investing to flying so often that I forget there are other disciplines out there that are actually pretty good parallels and great analogies to dig into. And I thought a couple of his examples really hit home. I love analogies like that just simplify how we could and should think about investing. Particularly, I think of Chris as a trend follower, and I think some of his comments about following asset flows, about not trying to get ahead of the market too much, but just waiting for charts to show you that the trend has changed, and really the benefits of avoiding just diversification for diversification's sake, but really focusing on where the opportunities are, where the charts are improving and leading into those, looking for charts that are underwhelming and leaning away from those, and rinsing and repeating that process. I would wholeheartedly agree with Chris's evaluation that is often one of the better approaches for individual investors. Hope you enjoyed that conversation. Always interested to get ideas for others we should sit down with virtually or maybe someday in person for the Market Misbehavior podcast. Whoever you're listening to this, make sure you drop a comment, give me some ideas. Always interested to hear ideas of who else we should sit down to and try to get their thoughts and dig into their thinking a bit. By the way, if you like this sort of analysis of the markets using charts and technical analysis, if you want to do more in 2025 and beyond to improve your own decision-making using a well-trodden path of technical analysis and trend following, you may want to check out our Market Misbehavior Premium memberships. Our premium members enjoy 3 really cool things. Number 1, virtual courses. Our first course is called the Flight School Behavioral Investing. We'll really unpack the main takeaways of behavioral finance and set you up for success with some basics of the technical analysis toolkit. Then we have some other virtual courses to really build out on those themes in a lot more detail. We have a members-only community featuring other members like you, similar-minded, trying to answer some of the questions you are asking. And it's great to be able to ask questions of me and others in that members-only community. A lot of great discussions here recently trying to navigate year-end into the beginning of next year. And then finally, we have custom and premium members-only reports like our weekly flight plan, our core report that we put out every weekend, our monthly chart review where we apply our proprietary market trend model to a bunch of different asset classes and share takeaways on the month that just occurred and look forward at the month to come. So make sure you go to marketmisbehavior.com/premium. Make sure you use the code podcast when you check out for a special deal on a monthly or annual membership for your first 12 months. For Market Misbehavior, I'm Dave Keller. Have a fantastic holiday season. We wish you very, very well, and we'll look forward to a lot of great conversations in the new year. But between now and then, remember, it's always a good time to own good charts.